So, any idea?
Revenue.
I remember you mentioned that IAS 11 is for the new construction contracts, I think, yeah. But 18, I'm not really sure. What is it? 18. Okay.
So these two were the standards in the past. And then the standard felt, or IASB felt, this may not be I mean, these two standards are pretty outdated. And then need to build in the current environmental changes with regard to the way the business works. And then they came up with a new standard. So IAS 11, IAS 18, they combined these two and they brought IFRS 15. There are various reasons behind this. Let's discuss those. See,
Are there
when you
links?
talk about revenue, hello?
Yes, yes. I just want to ask,
Yeah.
are there links, a lot of links, between those two,
That's
standards?
exactly what I'm going to discuss now.
Okay.
Now, why standard board need IFRS 15 instead to keep separate two standards? Now, IAS 11 focused primarily on how to account for contracts. So, construction contracts. How to account for construction contracts. Whereas the same IAS 11 went on to nitty-gritties of recognizing revenue generating from
Construction contracts.
construction contracts. There are different topics such as percentage of work completion and work certified. These type of terms are interchangeably used when discussing IAS 11. These type of terms were interchangeably or repeatedly used when you discuss about IAS 11. Also, another aspect of IAS 11 was to deal with inventory. I would say property inventory. I would say property inventory. So, what this will be, now these inventories are part of the partially completed construction progress. And how you recognize that in the balance sheet they were discussed in the past. Understand me?
Yes, clear.
Yeah. On the other hand, IAS 18, revenue. So, old standard were discussing which point you should recognize revenue. So, let's say this is seller's territory, this is buyer's territory. So, now we need to find out which point that we will be recognizing revenue as a good, as an item sold to the customer. Standard went on to say a point in which risk and rewards are transferred to the buyer. Then the seller should recognize this is an old, the previous IAS 18 way in which you recognize revenue. What they say? A point in which the risk and rewards are transferred to the buyer. Clear? Hmm?
Yeah. Is there an example for the the point? Yeah, which is crossed with the red.
Yeah, I'm going to discuss that now.
Okay.
Let's assume no, you all in Riyadh, right?
You're talking about shipping. That's
But
because this is in my mind. That's what I want
what is the largest mall you have there?
to. Riyadh Park, for example.
Via Park?
Yeah, it's the largest mall.
Oh, let's assume Via Park. And Mr. Haitham wanted to purchase one TV. He goes there and he goes to the electronics section. He make inquiries. And this TV, how many inch, whether it is color, is it smart TV, is it what do you call that, 4K, OLED, LED, OQLED, all this. You inquire and then you go home. Can the mall recognize sales?
No.
They can't recognize sales. That is not when the mall has transferred the risk and rewards to you.
Correct.
Next day, you go with your wife and both of you doing additional due diligence with regard to the TV and you questioning when is it stocks are available, can we order tomorrow, and you raise these type of questions. And you again go back home, can still the mall recognize revenue?
No.
No. Then third day, you go there, you place an order, you request that we need the TV. The shopman says, sorry sir, at the moment we don't have TVs in our showroom. We need to bring the TV from the warehouse. So you place an order, you make an advance. So an advance is paid. advance paid, let's say total TV price is 3,000, you pay 200. Now, can the mall or this largest mall, can they recognize the revenue of selling TV?
It's an
No,
advance.
this is
No,
advance amount.
down payment.
This is, yeah. So what do you think the double entry for this 200?
Advance account debit to cash or bank.
You where do you
No,
debit?
no. Debit,
Debit
down
the advance.
payment.
Yeah, down payment.
Down payment.
No, please wait. Who receives the
Okay.
money?
Okay, bank or let's say
Debit
cash.
cash and the credit to
Cash.
the advance.
Not advance, down payment.
And credit to?
Down down payment, yeah.
Or sometime I can also call it
Advance.
Credit to unearned or advance paid.
yeah. Now question. Now this 200, can I take to PNL as income?
No.
I cannot recognize this 200 as income. And if the TV deal will not happen, what should the mall do with this 200?
Return it back to the
Okay.
customer.
So this should be shown as what then?
It's shown as in their books, in the mall's books,
Yeah, I'm talking about the mall's books only.
a liability.
Exactly. It should be shown as a liability. Actually, current liability.
Yeah, current liability.
And we have a special name for this.
Deferred revenue.
Yes. Deferred revenue. This will accumulate in this particular account once the complete deal done. And the risk and rewards are transferred to the buyer. That point, you then recognize the sales. If you are going to recognize the sales, the double entry will be, you will have one account called
Sales.
sales account, and you will then have one account called bank account, and you already have one account called deferred
Revenue.
revenue account. Here you have 200. This is already a balance.
Correct.
Now, total sales value will be
Total sales 3,000. Yeah.
3,000. But how much cash I will receive now?
200.
No, Habibi.
Okay.
انت هو اتباع اول اتباع 200 ريال.
Okay.
So but total 3,000. So balance, how much he will give? My sales value
That's 3,000.
3,000. Customer already paid me
200. Still we need
how much balance I need from him?
2,800.
Exactly. So this will be the balance cash that I need to receive, correct?
Okay. Yes, correct.
So then I will debit here
Okay.
2,800 and I will credit here 2,800 and I will write here sales. And then I will write here bank. But as we know, our total sales value is 3,000. So what we should do, we should transfer this 200 from deferred revenue to
Sales.
So this will be 3,000, 3,000, and this will go to
PMW.
Is that clear?
Yes, yes, clear.
So this accounting, this concept and all is old. Anyway, the double entry will remain still the same, but the way you recognize the revenue has changed. For that purpose only, now we have something called IFRS 15. Revenue from contracts with customers. Supersedes IFRS 11, construction contract, IAS 18, revenue, and also IFRIC, customer loyalty programs, and IFRIC 15, IFRIC 13, and IFRIC. But I hope by now you all know the meaning of IFRIC. Yes or no?
Yeah, it's related to the committee. I mean,
International Financial
Operational
Reporting
Reporting.
Interpretations Committee.
Yes.
So agreements for the construction of real estate. So this all done. Now we also implicate in transfer of assets from customers. And this SIC, the SIC is, okay. Yesterday you remember we talked about a timeline, 1973 to 2001, 2001 to today. You remember we discussing this?
Not trying to recall.
We talked about the development of from IASC to IASB. You remember this or you forgot?
I think that this is in the first class.
No, yesterday, brother.
Okay, yesterday. Okay.
Yesterday, when we discussed about convergence and developments in financial reporting, we discussed about the way the standard setting progress. Now, actually, the 1973 only IASC came to being. IASC came to being on 1973. And whereas there were a lot of development changes and then it went on. And then 2001, they discontinued IASC and then they come up with what you call that IASB. So before
Okay.
it is IASC, then later after 2001, that became
ISB.
ISB. Now, what is the significant difference between these two? During this regime, they were issuing IAS only. During that regime, there is no other any type of IFRS. Do you understand me?
Yes, yes.
So, in 2001, since IASB formed, they kept on issuing IFRS. And during this time only, for any new standard, they also have something called IFRIC. What is IFRIC? International Financial Reporting Interpretations Committee.
Okay.
Correct?
Correct.
On the other hand, during this regime, in addition to this, they also had something called SIC. They also had something called SIC. So, they also had something called SIC. Now, I hope you are getting the difference.
Yes. It's
From 1973 to 2001, the issuing body is IAC, and they are issuing IAS and SIC. IAS full form, International Accounting Standard. And what is SIC? Standards Interpretation Committee. Understood?
yeah.
On the
Is
other
this,
hand, when you move on, pardon?
Yeah, I just want to ask, about these abbreviations.
Yeah.
I don't know if you have, like, let's say, I know that it will not be asked in the exam, but just for our knowledge and to know more about,
Yeah.
these kind of names. Do you have, let's say, let's say,
If I understand from you what you're trying to ask me, do you have a list of abbreviation with the full form?
Yes, exactly.
No worries, I will send you one.
Okay, thank you.
Yes,
I'll
Mr.
share in the
Muhammad
group.
Dalal. Due to the
Assalamualaikum,
internet
Habibi.
disconnection, I just joined again.
Okay, we'll call Pakistan government. Huh? And don't put Imran Khan in trouble and put you in trouble with internet.
Okay, sir.
Okay, no problem. So we were just started discussing the revenue recognition, and then in between we had to talk about this IFRIC and SIC. SIC is Standards Interpretations Committee. During this period, they were issuing that only. Now, once we move on to 2001 onwards, the standards issuing body, they have renamed to IASB,
IFB.
and they were issuing IFRS and
And now ISB.
IFRIC. Don't get me? Understood or not?
From my side, yes, it's clear.
Good. So another SIC became superseded after the introduction of IFRS 15 is SIC 31, revenue barter transaction involving advertising services, and that is a robust framework. Now, what is barter transaction? I hope you all know what is barter. What is barter transaction? I hope you all know. Yes or no?
No, I don't know.
Yeah, yani
See,
for exchange,
a time when time when there is no money.
yeah, that time they used
Yes.
to exchange the goods and
And I need rice and I have sheets. What I do, I go with one sheet and I give my sheep to the man and take one bag of rice. So the question is, how fair to the one or the other party? If you look into a sheep or a goat, the cost of the sheep or goat could be 700 real, and one bag of rice could be something like 80 real. So how fair this transaction is? But you cannot avoid this. But there is no mechanism of floating the sheep and then storing that in a refrigerator. These options were not available. Understood? And also, there was no option, no possibility of globalization. There's no possibility of globalization. Everything within the village, within the very narrow scope, within few houses, maybe 10, 20, 30, and it is, led by a given dedicated tribe. This tribal-based living style is that time. And that time, no money, so barter transaction. So, this 631 also talks about the possibility of, if any such possibility of barter transaction involving advertising services, that also addressed in 631, that also has been superseded because of IFRS 15. Definitions under IFRS 15. Now, we have revenue. Now, what is revenue? Income arising in the course of an entity's ordinary activity. Income arising in the course of an entity's ordinary activities. I would like to discuss the term ordinary activities. Now, let's say you go to that particular largest mall, and this largest mall, they buy one motor vehicle. Buy motor vehicle, buy TV. Now, looking into the nature of the business of that mall, how can you categorize these two transactions? How can you categorize these two transactions?
Can you repeat this, part, because I couldn't hear you well.
No problem. We talked about that mall in
Yes.
Riyadh. Okay, and this mall purchased one motor vehicle, and they also purchased one TV. But having understood, the mall is already selling TV.
Mm-hmm.
So they bought TV and they bought motor vehicle. Now, how can I categorize these two transactions?
I see.
Now,
Purchases.
having understood the nature of the transaction with this mall, would they be purchasing motor vehicle on a routine basis?
They have purchased it. Am I correct? Okay.
No, they purchase, correct. Because anyway, any business may be needing motor vehicle. But the question is, this purchase is part of their day-to-day ordinary activity. That is what we need to think.
Mm-hmm.
No, when I say ordinary activity, the activity that is there to buy and sell.
Okay.
So the more ordinary activity is what? They will buy
And so
and sell household, electronics, and uh, uh, grocery items. Am I right?
It's usually written on the Sajil Tijari. Every
Yes.
company, like activity of the companies.
Yes, yes. The Sadda Tijari will clearly say what should be the activity. Ignoring the Sadda Tijari by understanding the nature. Now this mall, their day-to-day activity is this. Now they went and purchased one TV. Now buying one TV will fall into which category? Should they consider TV as an asset or should they consider TV as an inventory?
inventory.
Inventory. Whereas motor vehicle should. Yes, Mr. Zubair. Any other thinking?
Yeah, now I got it. And if they have the same business, so we cannot consider this.
See, what happens is they buy TV for resale. Correct?
Yeah.
So when I am purchasing TV for resale, then that TV cannot be considered as an asset.
Yeah.
Whereas this more purchasing motor vehicle, is it for the purpose of reselling?
No.
No. Clearly said, right?
Yeah.
That is not for the purpose of reselling. So then what is the outcome of the motor vehicle? How you should treat this? This motor vehicle should be shown in the books as what?
Asset.
Very good. That should be shown as asset. In other words, it should be shown as non-current asset. Am I right?
Yeah.
Whereas TV should be shown as a trading stock.
Inventory.
Yeah, inventory. In other words, inventory. So, what I wanted to say that to understand, clearly understand what you mean by ordinary course of the activity.
Yeah, now got it.
So, income arising in the course of an entity's ordinary activities. Whatever the sale income, okay, I will bring another example. In Riyadh, what is the famous motor vehicle showroom?
Al Jabar.
Okay, Al Jabar. They are selling what vehicle? They are franchisee owner for which brand?
All the brands they have.
They have all the brands?
All the brand, but
okay, then we'll talk about Toyota.
Yeah, Toyota. Toyota only for Toyota.
Toyota Abdul Latif Jamil, that's own at
So this Toyota, they purchase 100 or 10 vehicles from Japan. Now, these 10 vehicles, normally from our normal understanding as we being accountants, when I see a motor vehicle, I will treat this as an non-current asset. Yes or no?
No, because they are operating as a business, so this will be
this is fine. But I'm talking about in general. When you or me happen to see a motor vehicle in some books, our normal thinking says I should treat this as a non-current asset.
Yeah.
Correct, no?
Yeah.
But however, you need to see what is their activity. The Al Jabar main activity is buying and selling motor vehicles. So when they purchase this motor vehicle, this should not be shown as
Non-current assets.
non-current asset. This should be shown as trading
Stock.
Mr. Zubair, you understood?
Yeah.
Very good. So, now what is income? I think I discussed this with you all. You see,
Yes,
asset is equal to equity plus liability. Hope I discussed this with you.
yes.
And my equity only is equal to asset minus liability. Correct?
Correct.
On the other hand, if I see equity, equity is equal to capital plus profit minus drawings. This is the normal composition of equity. Now, and we know that profit is revenue or income minus
Expenses.
expenses. So what we're trying to say, when I wanted to define income, because of the income, what will happen that my profit will increase. Shavalala, yes or no?
Ah, yes, correct.
And if the profit will increase, what will be the net outcome to the equity?
Increase as well.
It will also increase. So income is an activity, an economic activity that will result in increase in the net equity. Understood?
Yes, clear.
So that's what they're going to say here. Increases in economic benefits during the accounting period in the form of inflows or enhancement of assets. Now, if either what could happen is that you could also look at in this manner. You could, if you increase your assets, if you enhance the value of your assets, what could be the outcome for equity? Equity will increase, correct? And this increase also due to increase in
Income.
income. Or alternatively, what could also happen, you may have a reduction in liability. If the liability also reduces, that also will result into an increase in
Assets
equity.
and
See, while now, for example, my total asset 100, equity 60, liability 40. And I don't change anything here, but what I do, I make this as 35 and automatically this will become 65. Do you see that? So there is a reduction of 5 here and an increase of 5 here. What is the net impact? Still the same, correct? The net impact is still the same. So either increase in the economic benefits or a decrease in liability. A party that has contracted with an entity to obtain goods or services that are an input of an entity's ordinary activities in exchange of consideration. What is consideration? What do you think? What is consideration is?
Yeah. I think event happened and we consider at the same time.
Yes. Oh, no, I'm sorry. I missed what you told me.
Mm.
Hmm? What is consideration? Let's say you go to a shop and you buy banana. Banana is 4 riyal. Now you receive banana. Receive what? Banana what? Worth how much? Receive banana worth how much?
4.
4 riyal, right?
Yeah.
So in order to receive banana worth of 4 riyal, you had to pay a consideration of cash 4 riyal. So the consideration is how much now?
4.
4 riyals.
4 riyal. I hope this is understood.
Yeah.
Yeah, now it's clear.
Yeah. Give me 2 to 3 minutes. I'll be back with you. Okay.
Okay.
Hello. So, that I hope now it's clear about what is consideration, correct?
Correct. Yes. And your voice as well as the quality of your sound is clear now.
Now, is it different or same?
Very different. Previously, it was better.
1 second, I know the reason now.
The coming out of words, you know, it's unclear.
Okay, now I hope now it's clear.
This is the same when you started just now?
No, it's different.
Yeah,
See, actually, what I was doing, I'm using a Bluetooth device for
I know. But sometimes that, you know, it shows that, you know, the coming out of words, it's not that
but
clear,
now,
you know.
now I hope it's much clear.
I can say 80%.
80%.
Yeah, because
Okay. This is what you call blunt opinion. Yes. Anyhow, so what I wanted to make sure that you understand.
Now it's better. Yeah.
Yeah. So inshallah, we'll continue to keep the best out of it. So what I wanted to make sure that you understand the
I
term.
was praying. Sorry.
Maafi mushkil. You prayed for us also, right?
Yeah, I just came in back. Yeah.
So the term consideration is a vital term. We will be using this term in time to time in all the standards. Whenever we future standard we will discuss the term what we call this consideration. So consideration is the money. In simple, if I keep it simple, how much money you're going to pay for getting something.
Okay.
Understood?
Got it.
Yes,
Yeah.
very clear now.
Yes. So that is the simplest form of explanation.
Fine.
But it is not necessary that you should only think cash. Maybe instead of cash, you may also give away something else. You understand me?
Yes, clear. Which is similar to barter, what as you mentioned.
Yes, correct.
Okay.
Now, steps to IFRS 15. Now, in order for you to recognize the revenue under IFRS 15, standard under IFRS 15, we need to follow these steps. There are 1, 2, 3, 4, and 5. So, first one, identifying a contract. You should identify a contract clearly. You should identify a contract. If not, then you cannot recognize revenue from that particular contract. Now, let's say you have I hope you all know this term.
AMC. What is this?
AMC?
No, not clear to me.
Yes or no?
No.
Habibi,
mutual
Walla muskila.
Agreement mutual. What is it?
Annual maintenance contract.
Okay.
We call it AMC.
Yeah, that's what I written here.
Okay, because it's showing. I didn't see the AC.
Oh, I see.
In Arabic, and Arabic, we don't have that abbreviation, so we are sometimes, it's comfortable for us to say the word in the same, let's say,
So what you encouraging me to do that, use the full form instead of using abbreviation.
Yes, please.
Okay. Okay. Understood. Agreed. Bizap. So now in this, let's say normally this is come for cleaning company or IT service company or sometime real estate company. These companies sign up this contract. Yes or no?
Yes.
And how they gonna recognize the revenue based on specifically identifying the contract. You got to identify the contract specifically.
Mm.
If not, what could happen is that if not, what could happen is that we will be on a gray area as to are we addressing on a specific contract. So are we addressing, dealing with the right contract will be a problem. So that is the first step. So identifying the contract. Second, identifying performance obligation. Before that, I would like to discuss one more thing. IFRS 15 and IAS 18. The way revenue recognized. Under IFRS 15, we discussed that the risk and rewards to be transferred. Risk and rewards to be transferred. This is under IFRS. Sorry, I made a small mistake. I'm sorry for this. This should not be IFRS. This should be IAS. So under IAS 18, the way how you recognize revenue when you transfer risk and rewards. But in IFRS 15, they say when the control of the goods and or services transferred to the buyer. When the control of the goods and or services transferred to the buyer, that's when you recognize revenue. You understand the difference between these two? Actually, it's like
It's
this.
clear now.
Yeah, it's like this. Now this is risk and rewards, whereas this one is the controls. So it's not enough for you to ensure the risk and rewards to be transferred. It is also important that the control must be with whom? The control must be with
Buyer.
buyer. So now it's no point you deliver the TV home and you don't give the remote control and you cannot recognize the revenue because the buyer must have the control of the TV. But the problem is you need to verify that buyer at his home, his wife also there. Then he cannot control the TV.
Okay.
Yes or no? Normally,
No.
normally what happens is husbands cannot really control the TV because the remote, not only the remote, everything at home is not.
It's her kingdom. Okay, I agree with you. Okay.
Hope three of us are not in that environment for others to listen what we're talking now, right?
Well,
Otherwise,
let's
we will get what we call that assaulted by someone, and then we need to go to hospital.
let's say ladies first. Then this is much better.
Yes. So the key question here is the buyer receiving the control of the goods and services. That's the point when you will recognize the revenue. So that is one of the key change between IAS 18 and IFRS 15. Okay. So now we need to talk about identifying performance obligation. Now in the contract, when you're signing up the contract will identify what are the performance obligations that you are signing up. Now, if I am signing up for an audit service, say I'm an external auditor, and then when I'm signing up an audit service with the client, so what are my performance obligations? Complete an external audit and complete an external audit and complete an external audit and issue complete an external audit and issue a financial statement with an opinion in the audit report. This is the what you call the performance obligation of the external auditor. Correct?
Yes, clear.
So you are signing up the contract for this, and if you are not fulfilling, I need to take up this call. I will give me 2 minutes. Huh?
Okay, sir. Okay.
Take your time.
Then with an urgent call, I have to take it up.
No issue, sir. No issue. Mr. Haitham, you are in Riyadh?
Yes, I'm in Riyadh.
Ah, mashallah. I'm also in Riyadh.
MashaAllah.
Which company?
I'm in financing company. I'm
Aha.
in the financing.
Okay. I work in Al Ruwad Electronic. I'm also in finance controller.
MashaAllah. And I'm a senior financial analyst. I'm not that.
Mashallah.
Yeah.
So we can have, I think, we should meet somewhere to
Inshallah. Yes.
we are
Why not?
we have
Yes.
in same city.
Same
We should
city.
meet
Yeah.
someday, inshallah.
Inshallah. Why not?
Sure, brother. Sure. So actually, I live in near Malas, Fota. Maybe you listen the name
Yeah.
Fota.
But currently you're in Pakistan, huh?
No, I'm in Riyadh.
Oh, you're in Riyadh. Okay,
Yeah.
I see.
Mr. Muhammad Dalan, he was just joking because usually they are disconnecting the internet due to one of politician Imran Khan.
Yeah. Okay, I got the joke now.
Yeah.
He's talking to us.
Yeah,
Yeah.
back and forth. It is important that we keep the class live. It's not like, one teacher coming and then he is just keep on talking and you people listen and go. And I really don't like that. I like an interactive, very agile and more jovial environment. That's where
Yeah.
I wanted our setup. Otherwise, what's going to happen? We will be more mechanical and robotic type of situation. So at the end of the
And
day,
there
we
will
all
be
are human.
no use and no benefit.
Exactly. Yes.
Yeah.
See, and also at the end of the day, we all human beings. So we need to express and share our experience in order to make this journey a very fruitful journey.
Yeah.
Correct.
So that's the scenario. Anyhow, so now I'm talking about this performance obligation. Now, if it is an external audit, now I'm sure both of you have come across an engagement letter.
Yeah.
Yes.
These auditors sending you an engagement letter and asking you to pay 30,000 riyals, 40,000 riyals for their audit services.
Yeah.
So now, this is not just you need to pay. You need to ensure they are fulfilling. They are fulfilling what? They are fulfilling the performance obligation. So in any example, a construction contract or annual maintenance contract or sales contract or even employment contract, everything, there should be something called performance obligation. Am I making myself clear for you?
Yes, it is clear.
Okay. Third one, determine the transaction price. So you need to determine the transaction price. We need to determine the transaction price in this contract. So first we identify the contract. Second, we find out the performance obligation. Third, we need to find out in short. Yes. So determine the transaction. To keep it very simple, how much? What is the transaction value? If you are buying a TV, 3,000 riyal. If you are buying a motor vehicle, 85,000 riyal. If you are signing up a construction contract, 5 million riyal. So how much is the transaction price that you need to identified. That is vitally important. And now, very interesting, I will give you one example. Now, purchase of a photocopy machine. Purchase of what? Photocopy machine. Now, I'm sure you both have experience in purchasing these equipments.
Yeah, fixed assets.
So then, and also please tell me whether you have come across this experience. When you are buying, they say that, okay, your machine cost is 27,000 riyal. So the purchase price is 27,000 riyal. What we will do is that we will also give you 3 years maintenance free. See, transaction taken place on 1 January 2019. Now today, so this is 31st December 2019. This is 31st December 2020. And this is 31st December 2021. How many years now?
3 years.
1, 2, 3 years. So we purchased the photocopy machine on this day. And they say that we give you 3 years maintenance. There's an English saying, there's nothing called free lunch. Heard of this? You heard of this statement?
Yeah. There is no free lunch.
If you get receiving a free lunch from somebody, please understand that there is an agenda behind this.
Yeah, definitely.
So, maybe we may have exceptions here and there, but general scenario is that. So the general scenario is this. Now, they are telling you, they are giving 3 years maintenance free, and the price they are charging you, how much?
27K.
Meaning that within this 27,000, they are packaging the
Maintenance. Yeah.
maintenance cost. You understand this?
Yes, yes.
So now what the standard is telling you, now see, we purchase on this date. So let's say this is our company, and this is the company photocopy seller, and they receive cash 27,000. Now the question is, in the books of the photocopy seller, now the sales account for 31st December 2019, how much they should show as sale?
27.
That is the
Okay, the total. You mean,
that is the hit. That is the hit here. That is the hit here. What they are saying is that now the standard is telling you allocate the transaction price to performance obligation. Allocate the transaction price to performance obligation. So here, now I did not give you one information. I will add that information here. If you will only buy the machine without signing up for the 3 years maintenance, then the price is?
It's the same.
18,000. No.
Okay, okay. I see.
Then the price is 18,000. So do you see that this particular sale has two types of sale. Sale of machine
Sale of services,
and
related
sale
services.
of services. Do you understand that?
Yes.
So sale of machine and sale of services. So sale of machine, how much will be my income?
You said 18, 27, okay.
So how much will be the, no, what is the 18 meaning? If you're buying a machine and you don't signing
9,000.
up for the next 3 years, then how much you think the value of the sale of machine?
Okay, it's, you said the machine is 18 and 9,000 is the
So the sale of
18.
machine will be 18,000. The
Yeah.
sale
And
of
the
services,
9,000. How much?
9,000.
Yeah.
Yes, the total is 27. Now the question is, can you recognize entire 9,000 as an income for 2019? See, here you have sold 18,000 worth for as machine, and you also signed up and received 9,000 for maintenance.
Okay.
And
Advance.
how long your
Okay.
obligation is? For this 9,000 is your minimum
3,000.
obligation for how long? How long?
3,000. 3 years.
3 years. That means for 2019 alone, how much I can recognize as income?
The okay. If we'll divide it to 3.
Very good.
Yeah. So it'll be okay, which is 3,000.
Correct. So 3,000, see here, 3,000, here, 3,000, and here, 3,000. Correct?
Correct.
Now let's think about the double entry now. Now, bank,
Advance.
we
We have
received
received in advance.
27,000.
Okay.
Correct?
Yes.
Now, 1 second. I received 18,000 and I received 9,000.
Right.
This 18,000 I will consider as sale of machine.
Machine. Yeah.
So this I will transfer to here,
Shelves.
and that will be 18,000 coming from bank. Understood?
9,000
Clear.
profit.
9,000. See, on 1 January 2019, this 9,000, can we enjoy this 9,000?
Can we, sorry,
Can
what?
we enjoy 9,000?
This is for 3 years, right?
9,000 for 3 years, but the first year is 3,000, which we'll have to recognize it.
Yes. See, on 1st of January. On 1st of January.
It's an
On 1st
advance.
of January, enjoy this entire 9,000 as my income.
Okay, but the service is not provided yet, or the
Correct. So that means on that date, this money is not belong to us.
yes.
So what you do is this 9,000 you transfer to something called deferred revenue.
Revenue.
On which day?
As of
December 31st.
No, no, on 1 January
1 January.
2019,
Yes.
coming from bank. 9,000. Now, what you do? Now we reach into this time zone. Now we are here. So we
Now we have to
completed.
recognize the services, which is 50,000. We have to
Now, for this 1 year, this 3,000 we have see, provided you have fulfilled the performance obligation, this 3,000 you can book as one of your income.
exactly.
So what you do now? You transfer 3,000 from here to other service income.
Yes.
And then I will have another account, other service income,
3,000.
3,000. And you, when you balance this, so what you do now? This 3,000 we take it from deferred revenue.
Revenue.
And now can we balance this? If you balance this,
Still have
9,000,
Still have
9,000,
6,000.
and this 6,000 we should write as carry forward.
Okay.
Now, in I'm preparing my financial for 2019, I need to prepare income statement and also I need to prepare balance sheet. Correct?
Yep.
So, in the income statement, as a top line sales, I will be showing
18,000.
18,000, and also I will show other service income 3,000. Correct?
Yep.
On the other hand, in the balance sheet, now if you balance this, see this one here,
Carry forward.
this comes down. $6,000, and that 6,000 should be shown as a liability under current liability as no. Here again, sorry, it's not only current liability. Now, this 6,000 you need to fulfill within next 2 years, correct?
Correct.
So under current liability,
so not 3,000.
revenue.
3,000.
Yeah, under current liability, deferred revenue 3,000, and under non-current liability,
3,000.
another deferred revenue 3,000. Understand me?
Yeah, clear.
This is the complete scenario in identifying, see, allocating the what you call performance prices to the performance obligation. Recognize revenue as you satisfy a performance obligation. So, if you fulfill all these 5 conditions or 5 steps, then you recognize the revenue. Clear?
Yes, clear.
Good.
Can I mean, the balance which you forwarded to, you will consider it?
Yeah, definitely.
Yeah, but can you please go back to this, page which you have written? Yeah, I want just to
No,
classify.
please wait, please wait, please wait.
Yeah.
I just need to answer a call from my son.
Sure.
Hold on, huh? Hold on.
No problem.
No.
Yeah. Now you can ask the question.
Yes, can you go up? Oh, no, sorry, down. Yes, the CF, the current, the the one which you have mentioned, that the carry forward.
Okay.
Yeah, this is the 6,000. That will be.
Is the total liability?
Uh-huh.
The
It's
total
the
liability are, yeah.
6,000, which will be carried over to the next year.
This date will be 1 January 2020.
Okay. Now it's clear.
So then you will continue 2020 and you will also continue 2021. Clear?
Okay. So we'll say that the bank account, other.
Yeah, go to bank account. Okay, bank account.
Okay. So the accounts that will be affected, the bank
Yes.
account and the sales from services income.
Yeah, services income, correct.
Plus,
So that
what
is
is the third account that will be impacted?
say one account impacted is sales account 18,000. Other account impacted is deferred revenue account 9,000. From this 9, I picked out
Two accounts only.
this 3,000 I picked out and then brought to other service income, and this I will balance, and this I will transfer to
P&L. Okay, now it's clear.
yeah. So this is what you really need to do. Clear?
Yes.
Yeah.
Mr. Zubair, you are okay?
Yeah.
Fine. Now we will go in detail as to these pointers. Parties to the contract have approved the contract and are committed to perform their respective obligations. Respective, the both parties, whoever involved in this contract, all of them should fulfill their obligations. The entity can identify each party's rights regarding the goods or services to be transferred. The entity, now I'm reading and I'm elaborating with the very minimal explanation. And if you need more interpretation, before that, and if I think I need to give external additional elaboration on the sentence, I will automatically go on. But otherwise, I'll just go on reading it and I will assume you understand. If you don't, please do let me know.
I will stop you.
Okay. So the entity can identify each party's rights regarding the goods or services. To now we talked about selling the TV, or we talked about signing up an external audit services, or we can also talking about booking a hotel room. See, in hotel is another good example. When the guest booking the hotel room, and you also give bed and breakfast. And suppose a guy from outside come and eating a breakfast, would you be giving free?
No.
That means the sales of the room and the sale of the food should be separately split from the total value that you're going to charge to the customer.
Yeah.
So issue is, brother, in that one EC live for us, both revenue taking place within the same time zone. So we don't need to worry that much. But if the time zone is different, like in my example of this photocopy machine, story is entirely different. The entity can identify the payment terms for the goods or the services to be transferred. How? Is it upfront cash? Is it a 3-month credit? Is it a lease term? Or is it an installment, equal monthly installment, or whatever? So that also needed to be identified.
Yeah.
The contract has commercial substance. There is something called legal form, commercial substance. It is more vital for you to see the commercial substance more than the legal form of a transaction. What do you think is the good example? The good example is vehicle lease. I don't know whether I discussed this with you all.
Yes, the leaser and the DC. We have discussed that.
We discussed this, right? So
Yeah.
in this situation, legally, the lessor will be the owner.
Correct.
But in substance, we need to record in the books of lessee. So this is what we are talking here.
That. Yeah.
It is probable that the entity will collect the consideration to which it will be entitled. An entity shall pay, shall consider only the customer's ability and intention to pay that amount of consideration when it is due. So this is also very important. Mafi Tal Bukra, that is story not acceptable. So you need to have a very clear understanding that is how sure the customer will pay you. Many companies currently facing financial difficulties. Why? Because they are over anticipating. Somehow you need to book the sales. So you go and meet any customer and then dump your goods or services on their head. Tell them, look, my friend, you pay me after 6 months. So if that happens, then that double entry, do you think it's a fake entry?
No, we should not.
See, now in ground level reality, if that customer do not pay you, if you booked that as revenue, is it fair?
Revalue, yes.
What do you think? No, I think you didn't get my point.
Yeah,
Now let's say today,
yeah.
today, 1 January 2022, I am booking sales 1 million.
Yeah.
If I book sales 1 million, I'll be very happy. Correct?
Yeah.
But the customer told you, my friend, I will only pay you after 6 months. Simply, you just accepted it because to boost your sales, you just done the services to them and then you book the entry. But this fellow is not paying.
He will pay in installments.
No, he's not even paying installment also. He's not paying at all.
Okay.
Then what is the use of booking this entry then?
It's a fake, you know.
It is no. Actually, from our side, to be fair, we have done our services or we have sold our goods, but yet this sales has been over anticipated. Correct or not?
Yes.
Yeah.
We shouldn't have accepted that fellow to say that I'll pay you after 6 months.
So we still have guarantees, you know.
So yeah, unless you have bank guarantee and that and this.
Yeah.
So here no such pre-qualification. Got it?
Yeah,
So,
clear, very clear.
See, for me to recognize the revenue, I also should have a clear idea as to whether the customer is capable of paying me.
The only
And
way
the
to
customer,
identify that,
pardon?
I said the only way to identify that is to get, you know, how
Yeah.
to say,
See, now when customer comes, there is something called creditworthiness assessment.
okay.
Do
It
we
would
do
consider
that or not?
well, yeah, but you know, the common practice is, you know, bank guarantees. That's what we.
Yeah, if you have the bank guarantee, you are in the safe zone.
Yeah.
But the problem is, brother, in the current market, even whether you don't have bank guarantee, yet you are forced to do credit sales.
I see.
Correct or not?
Correct. We have to check the
I will not
credit.
talk about the big level organizations. It's small, small to medium entities. Their business is all rotation.
Okay.
So what happens is that they tend to agree. They tend to agree credit sales also. So and the customer will come and give all the rosy stories. I'm king of that country. I'm the hero of this place. I'm so and so. I'm Superman. Blah blah blah. And you believe all this, and then you give the goods or services on credit. And subsequently, what happened? That fellow is the number one Alibaba. So when that fellow is the number one Alibaba, you are in serious trouble. Correct?
Correct.
So we should find out some sort of due diligence as to assess the credibility of the
Entity.
customer.
Okay.
And then here the clear point is that customer's ability and intention to pay. There should be a good niya to pay that amount of consideration when it is due. Mazboot?
Okay. Yeah, مضبوط.
So these are the pointers that you need to factor in when we looking into identifying a contract.
Yeah.
Identifying performance obligation. A contract inception, we need to identify performance obligation. A good or service or a bundle of goods or services. See? That is distinct or a series of distinct goods or services. It could be an alone good, alone a service, or a bundle of goods or services that is distinct, or a series of distinct goods or services. It could be anything, but you got to identify the performance obligation. Clear?
Yeah.
So Okay. So this is the second condition. Third condition. What now we need to understand? We need to understand what is distinct, meaning the separation. The customer can benefit from good or services either on its own or together. See? Now, in this example, the photocopy, we are paying 27,000. And this 27,000 is for machine and for the service. But when you looking into this is same like bundle, right? So are you in a position to distinct this separately? Clear?
Yeah.
Good. So with other resources that are readily available to the customer and good or service that could be used, consumed, sold for an amount that is greater than the scrap value or otherwise held in a way that generates economic benefits. So whether you are able to generate revenue separately. I will keep it this very simple. Whether the entity is able to generate revenue separately. Whether the entity is able to generate revenue separately. So that is the first point. The entity's promise to transfer the goods or services to the customer is separately identifiable from other promise in the contract. So you should be able to get the goods and those services separately. The customer is separately identifiable from other promises in the contract. Suppose if as you read in the contract, now you should be able to separately pinpoint what are the performance obligations the contract is going to offer. Understand?
Yes, clear.
So the entity does not provide a significant service of integrating the goods or services. The goods or services does not significantly modify or customize another good or service. The good or service is not highly dependent on or highly interrelated with other goods or services. I will simplify this. What they're saying is here, the entity does not provide a significant service of integrating the goods or services. We stop at this point, meaning the entity does not provide a significant service of integrating the good. Now, if it is annual maintenance contract, for example, you have an annual maintenance contract, their main, let's say cleaning company. Cleaning company annual maintenance contract is to come and provide cleaning services. And also suppose if there are equipments or parts broken and you need to, if the cleaning company is also doing the repair. So what happens? One service is cleaning. Another service is repair. Repair and maintenance. If you are unable to integrate both, if you are unable to package it both, then you need to consider separate. This separate and this separate. But if you can't integrate, then it will be a bundle of services. The goods or services does not significantly modify So in this situation, when you are unable to integrate, the different services that we are talking about will not modify if you happen to integrate. You understand me? Before, after. Before, I am without integrating, here with integration. Even in these two situations, the separate services will not significantly modify. You understand me what I'm saying now? Whether you are separately, without integrating, you are performing separately, or you are performing together, yet the service model will not significantly modify. Get me?
It's clear now.
Brother? Yeah,
Yes,
good.
I'm with you. It's clear.
Okay, that's great. Or customize another good or service. The goods or services is not highly dependent on or highly interrelated with other goods. So no, it is not interconnected. It is totally on its own. That's what we wanted to say. So these all means distinct. A direct meaning of distinct is
Separation.
separate. Yeah, separation, separate. Measuring progress. Apply a single method for each performance obligation satisfied over time and apply that method consistently to similar performance obligations in similar circumstances. What do you mean by this? How I know the price? How I know the price? So that's what they are going to elaborate here. You could work out in different methods. Input method, like based on what are the resources you are in putting into this process, you can work out the price, or you can work out the total cost incurred into this contract, or you can talk about the total hours that you spend, or you can also talk about output method. And here you can also do a market survey. And you know what is milestone reach?
Yes. The progress of the project, or
Correct.
once it's
So you can
completing,
also price based on milestones reached. Then units produced or delivered outcome not reasonably measurable. Now, if the outcome is not reasonably measurable, then what you have to do is you also need to work out and find out what are the units we produced, or how much we delivered, and when we are whether it is measurable or not. Measurable or not. And also we need to work out or ask another question, whether we can recover any of the costs that we incur. Suppose, if I can recover the cost, then when I'm arriving my selling price, so my selling price, what I can do is that, and here to work out this, I need to know the cost. Let's say the total cost is 100, cost I recovered was 20, so my net cost will be 80. And my profit is 30, so my selling price is 110. So please look that I am not taking 100, I am taking 80. Understand me? So this is the cost recovered. The entity shall recognize revenue only to the extent of the cost incurred. So what they are saying, target revenue 1.5 million. You signed up a contract with one customer for 1.5 million. Okay? You incurred cost. You incurred cost 800,000. And so far, received,
700.
no, 800.
Okay.
So far you received 800 and you receiving a message that you will not be collecting the remaining 700,000. So in this situation, what you need to do is you need to recognize revenue to the extent of the cost that you incurred. So here, how much should be my revenue?
800K.
Although contract that I agreed 1.5 million, I cannot charge 1.5. I have to recognize revenue 800,000. Suppose the revenue that can I recognize 850?
No.
No. Now, if I received 750, my cost is 800. So far, I have received 750. In that case, I should only recognize
750.
750. Mr. Zubair, you understand the logic?
Sorry. Unfortunately, if you don't mind, can you? Yeah, I'm really
No
sorry.
problem, no problem. But see the last point in that slide, the entity shall recognize revenue only to the extent of the cost incurred. So what I wanted you to know, the target revenue that the agreed contract value. Agreed contract value 1.5 million. Okay?
Yeah.
And the contract cost that is you incurred was 800,000. Now the question is how much I should recognize as revenue. Customer, you get a indication that he will not pay you 1.5. But so far you received 800,000. When you have received 800,000, you should recognize revenue only to the extent of the cost that you incurred, meaning 800,000. Understood?
Yeah.
On the other hand, if can you recognize 850?
No.
No. And suppose you have only received 750, how much you should recognize revenue?
750, whatever we receive
750.
against that.
Exactly.
Yeah.
So now determine transaction price. Transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised of goods to the customer. This is how much? In simple, in one word, how much is my money or my cost or my income, sorry, excluding amounts collected on behalf of third party. For example, some sales tax. I hope you all come across something called VAT or sales tax or GST. Have you come across it in Saudi? I'm sure now VAT is very famous.
Yeah, that sales tax is also famous.
Yeah, VAT, sales tax, GST actually a substitute for. GST is a substitute for VAT. So anyway, let's assume bring one example. Your sales value is 1,000 and your VAT is 150. You receive from customer 1,150. But in the P&L, how much you should show as sales?
1,000.
Only this.
Yes.
Will be in the P&L. And this will be payable to
authorities.
To department.
Yeah.
Correct?
Correct.
Yeah.
Yeah. And also, then sometime when you're signing up a contract, there could be possibility of addendum or variation. The contract can vary. Then possibly you may have variable consideration. More than fixed consideration, you may also have variable consideration, constraining estimates of variable consideration. What are the possibility of a variable consideration? So we will discuss that. See, now a customer, you agree a price, selling price, 1,000. Okay. And do you aware, do you all aware about discounts?
Yeah.
Yeah.
There are two types of discount. One is
Trading.
Cash
trade
discount.
discount.
Yeah.
Other one is
Cash discount.
cash discount.
And sales.
So one is trade discount, other one is cash discount. So what do you mean by the trade discount is actually a discount because based on the bargaining power between the buyer and the seller. Correct?
Yes.
So if I draw a timeline like this, the trade discount, this is the sales point. Okay. Now during this time, this is negotiation period. And during this period, let's say your display price 1,000, but the customer goes on negotiate, and then you agree 800. So, what you call display price is 1,000. Agreed price here 800. What is this difference?
200. Okay.
Yeah, this 200 is named as what?
Discount.
Yeah, correct. But one more additional word,
Trade discount.
trade
Okay.
Trade
discount. Now the rule is that no trade discount is accounted. No
What
trade
about
discount is. Pardon?
what about penalties? Sometimes, if you delayed, the
Yeah, if it's a penalty, then you receive interest or fine or surcharge, that will be an additional income for you.
I see. But it's
This is the
okay.
other side of it. No?
Okay.
So now
But
what's the,
are you going to consider it as discounts? If
yeah, let's see this. But let's complete the scenario, then you will understand.
okay, sure.
So the trade discount is not. No trade discount is accounted, meaning any amount over here that will not go into the books. So my sales invoice, I will show how much. Will I be showing 1,000 or will I be showing 800?
No, 800.
Very good. I will be showing 800. So when I generate invoice, I am sure you all know that we need to pass double entry. And assume this sales on a credit sales. So where will I
Okay.
debit?
Debit the sales with the
It's a credit sales. Okay, tell me where to credit.
okay.
credit. Sale invoice.
Yeah, I have just done a sale. The sales invoice value 800. But this sales is on credit. Tell me the double entry, please.
Okay.
Sales will be credit.
Pardon?
Debit will be receivable.
Credit?
Sales will be debit will be the bank.
Credit.
Sales will be credit.
Bank or the
800.
credit.
And bank.
And we cannot debit bank because we are not getting cash.
Okay. So it's be receivables.
Credit is
Yeah, receivables.
receivable.
Okay.
Receivable.
Yeah.
So we will debit. And now the seller is made another additional agreement with the buyer. What he told, look, my friend, so let's assume this date, This date is 15th of March 2023. Okay, and normal term for you, for this buyer, normal terms you agreed was 2 weeks. He should pay you within 2 weeks. But
Okay.
you also told him, look, my friend, I will give you a discount if you pay on after 7 days. That means 22nd of March. And the discount, let's say 5%. Okay? So how much will be 5% then? How much is 5%?
20 or
800, yeah, 20, correct.
20, yeah. Okay, great.
Now, see, now the up to introduction of IFRS 15, the discount was dealt in a very light manner. But then IFRS 15 went on to talk about some additional aspect in relation to this discount. And that discount is exactly what you mean by variable consideration. I'm going to share one small note for you all. See, what is variable consideration? Variable consideration is consideration that is not fixed. It is estimated in step 3, meaning 3 steps, and includes items such as discounts, rebates, refunds, credits, price concession, etc., as well as amount that are contingent. So this will be the complete meaning of the word
Variable consideration.
variable consideration. But I'm just bringing one simple example so that this whole entire scenario will be understood. Okay, now we understood the discount that is to be given 20. So with the prudence in mind, what I have done, I have recorded receivable 780 and then sales 800, discount allowed 20. You understand that? So what is the double entry now?
Yes, now it's clear.
So receivable 780, discount allowed 20, and the sales 780 and 20. So this will be this is receivable, this is discounted. This will be the double entry. Now we are reaching to 22nd of March. Now we are here. And this customer is not fulfilling this condition. What is that he is not fulfilling? He is not paying you on that time. Now, if he don't pay on 22nd March, or if he delaying after 22nd of March, do you think he is entitled for this 20 riyal?
No.
He will not be entitled for this 20 riyal, and that is the variable consideration I'm talking about. What you do now, you credit here 20 and debit to receivable. And you won't have any more expenses. And this fellow need to pay you in full. So your total income going to be 800. Understood?
Yes, clear.
Yeah. If the customer is not satisfying the terms related to variable consideration, then respective entries should be reversed.
Clear.
Understood, right?
Yeah, clear.
Yeah. Discount, rebates, refunds, credits, price concession, incentive, performance bonus, penalties, etc. Now, I remember you told
Yes,
you talked
yes,
to me.
penalties.
Estimate the amount of variable consideration, the expected value. There's a mathematical calculation will come in. Expected value calculation, I hope you all know. Probability theory. See, outcome 1, 2, 3. Scales 800, 700, and 1000. And probability 40%, 30%, and 30%. Condition always, the total of the percentage must be how much?
100.
100. Yeah. So now, expected value, meaning what? You multiply this.
Okay, with the okay.
So 800 into 40%, 320. 700 into 30%, 210. 1000 into 30% is 300. So what is the total now? 320, 620, 630, 830. This will be your expected value. This type of calculation you got to perform in arriving the answer. The most likely amount or the constraining estimate include variable consideration only, to the extent that it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur.
You mentioned that, okay.
When the uncertainty associated with the variable consideration is subsequently resolved. So I hope with this statement, with my example, you understood.
Yes, yes.
Great. Financing component. The customer or the entity receives a significant benefit of financing the transfer of goods or services, recognizing at cash. What is this? So what do you mean by financing component? Now let's say you purchase a motor vehicle. The selling price of the motor vehicle is 250,000 reals. You don't have outright cash to pay. Then let's say now I'm referring example from Qatar. Abdullah Abdul Ghani is one company. They are the agent for Toyota. Abdullah Abdul Ghani, within the company, they have a finance wing. They have a car dealer ship, and they have a finance wing. So the vehicle cost is 250. Customer don't have that much money to pay. Then the Abdullah Abdul Ghani accept to finance this. So then what happens? They have income on sale of vehicle, and they also have income based on finance income. So this need to be split separately and then recognized. Understood? See,
yes.
What will happen? Cash, outright, price 250. If they will finance, it will be 300.
300.
Or
Okay, markup.
like
Yeah.
They will add something for the cost of
borrowing. Exactly.
borrowing.
Yes.
So they will add that. And
I see.
also, these days there is another installment business they do. I'm sure you are coming to this. 24 monthly installment, no interest. Have you seen this?
No interest.
Some of the offers like, yeah.
6 months,
It's
monthly
included.
installment. Jarir bookstore. The Jarir bookstore, what they do is that they sell electronics. They can say that, okay, you pay it in 6 months installment, no interest, but you pay up in total. What they really do at the back end, the pricing is done in such a way.
Yeah. They increase the cost of the good.
Exactly.
Yeah.
And you have something called fair value consideration. Now, if you have non-cash consideration,
we have companies here in Saudi Arabia which they are also doing the same third party, such as I don't know, Zubair, Tabi, and these new companies. Yes. They are also just doing the same. That there's an agreement between the seller and this third party that you will let me say fund the customer, and the markup will be between us, between the seller and the third party. Yeah.
Yes. So what is non-cash consideration? Meaning, instead of paying you cash, you give one of your asset to them. So then you need to work out the fair value of the consideration. Let's say you're buying a car and you're giving up one of your car. And the cost of the car that you buy is based on how much value you are foregoing for the car that you're giving. So, if you are unable to estimate, then the standalone selling price of the goods or services will be the fair value. Understand me?
Yeah.
Okay.
So, actually, I got to stop at this point. I will continue this tomorrow. And tomorrow I will discuss the questions on this as well.
Sure.
So thank you so much.
Question is good for us. Yeah.
Jazakallah khair.
Yeah. Thank you, sir.
So,
okay.
So always what I want is that I want to disseminate the knowledge in the right way.
Balancing the
Mashallah, you deliver very, very comprehensive, let me say, knowledge.
Exactly.
Yeah.
So that what see, final outcome is that, see, one thing I will stop after telling this. My father also teacher. My father is an English teacher. He used to tell me this. He used to give me 2 words. See the letters in these 2 words. Both are same.
Yeah.
Cheat, teach.
You should never be cheating people, but you must be teaching people.
Exactly.
In many situations, in the teaching industry, they don't really teach; they cheat.
Exactly. The good thing that also you are, let me say, laying on, let's say, facts or examples, and or reality. So it will help us to also to understand the.
We need to get the grip, and we need to relate what we learning in theory is really supporting our day-to-day life.
Correct. This will actually easy make it easy for us to understand it.
Definitely. It's like this. Like studying chemistry from science point of view. that chemical equation, if you really need to remember, you need to sit and by heart. But
Correct.
the accounting is actually part of our life.
Yes.
So
Yeah.
it should not be like, you know, learning chemistry or something. We should remember the discussion, even you don't really reverse it. But I'm not telling you should not do this, but even if you don't reverse it, yet the cream of the discussion must be sitting in your head. That's my intention.
I agree. I agree.
All right, sir. And actually, I need to run for another meeting. Some client is killing me, so
Yeah.
I will. You know, this is the auditor's life.
I know. I know.
So I will meet you tomorrow, inshallah, and
Inshallah.
we will continue this discussion.
Inshallah. Thank
Thank
you.
you so
Thank
much.
you. Okay.
I will share this material with you now.
Thank you, sir.
Yes.
Yeah, that's it.
And Mr. Zubair, I yet to receive an
Yes,
answer
sir.
for your question, and soon I get the answer, I will talk to you.
Yeah.
Huh?
Okay, sir. Okay, sir. Okay, sir. Okay. Thank you, sir. Thank you. Sure, sir.
Okay. See you tomorrow, inshallah.
Yeah, see you tomorrow. Jazakallah khair.
Yeah. Yeah. Assalamu alaikum.
Thank you, sir. Thank you.